New real estate investors often get hooked on the idea of passive income when they start investing in real estate. And because of that, they chase cheaper homes, often in questionable areas, because they seem to cash flow nicely on paper. And they believe that if they can increase their monthly cash flow, that's the best way and the fastest way to reach their investment objectives and become real estate millionaires. In this video, I'm going to break down for you why chasing cheaper homes is not a great investment approach, and why in the long run, buying up cheaper homes for cash flow is probably going to prevent you from obtaining the real wealth you're seeking. Welcome to Confident Real Estate. I'm your host, JC. Today we're going to give you some food for thought, because buying up cheaper homes in order to maximize your monthly cash flow, rather than really focusing on good investment properties that will develop capital appreciation, may lead you down a very dangerous path and put your entire portfolio at risk. So today we're going to make sure that you have a full understanding of how you should approach your real estate investments so that you can feel better protected, because at the end of the day, who doesn't like feeling protected? And of course, speaking of liking things, if you wouldn't mind hammering that like button down below, I'd greatly appreciate it to feed that YouTube algorithm. And of course, if you haven't yet hit subscribe, please consider subscribing to this channel so you don't miss any of our future insightful content. So what qualifies as a cheap property? Well, it differs from market to market, but historically, if you take a look at, say, the Midwest, the properties there are going to be significantly cheaper than they would be if you live on the East Coast or West Coast. And the simple reason for that is demand. Now, I know you're going to say, well, hey, hold on a second. In 2020 and carrying into 2021, we've seen a bigger demand for rural and certain suburban areas than we've ever seen before. And that's true. But generally, opportunities are more bountiful and incomes are much higher if you live in major markets that are surrounding more populous urban areas. So those are typically found on the East Coast and West Coast as compared with the Midwest. And if you live on the East Coast or West Coast, you may live in a market that's prohibitively expensive to enter into. If you could go buy a property for $50,000 in the Midwest and generate an $800 a month cash flowing return, well, that's pretty significant. $50,000 for $800 a month versus $500,000 for only $1,500 a month in the market that you live in. It's very tempting. That said, there are key principles to conservative and successful real estate investing that cannot be achieved simply by buying up cheap properties. And those key principles do include cash flow, but they also include capital preservation, equity appreciation, and tax benefits. The basic realities of cheap properties are that they tend to be in areas of town that are most likely on the decline rather in the path of progress, which impacts your tenant options. It hampers your ability to protect the capital that you've invested, and it really limits your ability to see any real equity appreciation in your investment. Because these cheaper properties are typically found in less desirable areas of town, you're going to have a situation with higher tenant turnover and a less pride of ownership caliber of tenant, which means you're going to have higher replacement costs, repair costs, and maintenance costs, which are going to interrupt and impact your cash flow, which is the sole purpose why you even bought this cheap property in the first place. Not to mention the fact that roofs and ACs and water heaters, they cost the same whether you bought a property that's going to develop equity appreciation or this dump that was supposed to have a cash flow. Insurance is going to be hard to come by, and it's going to be costly, because at the end of the day, you're buying this property for dirt cheap prices. It's probably going to cost more to rebuild and replace the property in the event it burns down in a fire than the property's worth. So insurance companies are not fond of making that kind of insurance deal with somebody who's got an investment property in a less than desirable area of town. And again, because of that exact issue, banks are not happy lending on those types of properties. It's going to be much more costly for you to get a loan on a property. And let's face it, banks have to do the underwriting, whether it's a $100,000 property or a $500,000 property. It's the same amount of work, and it is not worth their time to put in all that work for underwriting on a property that's worth less than $100,000. In many cases, They won't even look at a property if it's less than $200,000 because they can spend the same amount of time and go make a $500,000 loan on a $700,000 property where there is equity appreciation. They're making a $500,000 loan on a property that's worth $700,000 versus making a $75,000 loan on a property that you're paying $80,000 for, let's say, and that's a questionable value at that. When it comes time to sell the property, you're going to have a harder time selling it because it's a market that's going to have fewer qualified buyers. Real investors are going to go buy properties that also have capital appreciation and the ability to protect their capital investment. If you can't sell this property, it's going to put the capital that you invested into it at risk, and you're going to have to wait a long time to get that money back in order to go invest, if you can even get all of it back in the first place. One of the biggest drawbacks of the cheap houses is also the depreciation factor, because it's much harder to keep your cash flow tax-free, especially if you paid all cash for the property because you couldn't get a mortgage. Again, every market is different, but you should really, in general, focus on buying C+ to B- class properties in stable and desirable areas. And if you want to know how to find those stable and desirable areas where you should be buying, please click the link below. I'll leave the link in the description for this video on the entire video we did about how to do your market analysis. It is extremely important before you put your money on the table. Before you commit to any type of investment strategy, take a moment to really build a comprehensive investment plan for yourself. What type of properties are you looking for? Do you need cash flow? Do you want capital appreciation? Do you want a healthy mix of both? What type of investing works for you? What kind of time do you have to devote towards your investment plan? Like any business, it takes a while to get that first deal off the ground and really get your plan rolling and building your real estate portfolio. Be prepared for that. Research your markets properly to set yourself up for long-term success. And again, I'll leave the link down below for the comprehensive video that I did on determining where to buy. But essentially, you should be looking for markets where there's job growth, job diversity, population growth, affordability, and income growth. And the affordability needs to be both in the prices that properties cost to buy and in rents that your potential renters can afford to pay. Once you've narrowed your market search, pick 2 or 3 areas to do a deeper analysis of and start looking at properties in those areas that meet you with your investing goals. These are the toughest steps to get right in real estate investing, and unfortunately, too many investors shortcut these steps in a just desire to see cash flow and income rather than long-term wealth building. If you get these steps right, then you will be off to the races and your portfolio will grow. These aren't all the steps you need to know in order to start investing in real estate, but obviously these steps will set you up with a great investment plan and will help you to avoid some of the most common pitfalls that new real estate investors face, like buying cheap properties for the sole purpose of chasing cash flow. I hope you got a lot out of this video. If you have any comments or questions, because I know I threw a lot at you, please leave them in the comment section down below. If you haven't already done so, please hammer that like button for me to feed the YouTube algorithm. And of course, if you're not yet part of our growing Confident Real Estate family, please consider hitting subscribe down below as well. I appreciate you. Until next time.